Welcome to the STARS program, seniors taking active roles in society. And now, here's your host, Anita Finley.
Insurance, is that a good word? Is it a bad word? If you don't need it, it's not a good word. If you need it, it's a great word. And I have always been very close to my insurance salespeople because the smarter they are, the better I've had insurance for us, for my husband and for me. And so I have to tell you that I always look for very smart people who are in this business, and they've saved me years and years. And probably about a year or two ago, I met Robert Coulson. I think he's one of those smart people. And he has his own insurance firm. It's called US Insurance Auditors. And he always tells me if I'm doing something right, if I'm doing something wrong, and he always helps people. I have referred him to a lot of people now, and I'm so glad you're here, because people, I think they're more confused about insurance than anything. You know, they could bake a gorgeous apple pie. They could travel all over the world, but there's something about insurance that confuses people. Why is that?
Hi, Anita. It's always good to be here. That's a great introduction because it brings to the forefront a lot of things, actually. You said people don't understand insurance. They don't like insurance. It's true. The old adage is people don't want insurance until something happens, and then they don't want twice as much. And that's what happens because a lot of types of insurance that has been sold in the past isn't up to date with what today's market and what people need. What does that mean simplistically? It means the old annuities, the old life insurance, the old whole life policies don't really have the interest-bearing growth accounts. They don't have the riders on them that really allows the client and customer to use them prior to dying on a life insurance basis. On an annuity basis, there's so many different ways to participate in the growth of your money. And that's what I really want to talk about today is some of those different types of ways to grow your money in different vehicles. And one of those is what you see probably all over the print ads you might see today. If you log onto your computer today and you go on to any of these Palm Beach Post, sunsentinel.com, any highly used website, MSN, you see a lot of pop-ups coming into your windows. And what these pop-ups are telling people is basically things like this. If you own a variable annuity, you need to call us right away. Variable annuities are some of the worst products ever invented. Do you own one? Call us right away. We have a luncheon downtown Tuesday, Wednesday, Thursday next week. We will show you why variable annuities are not the vehicle you need to own. So I think that's why people are really confused, to be honest with you, because there's so many different types of life insurance today. We've talked about on previous shows. You know, you have the straight term policies. You have the whole life policies. You have universal life policies, variable life policies, guaranteed life policies, hybrid policies, index universal life policies. So it's very confusing for the customer.
Well, Rob, the thing coming from the consumer side, the reason people buy insurance and why we bought insurance, health, life, lots of things, is because when something bad happens, you either don't have the money in your savings account and you can't get any help, or you have money and you don't want it all to go. I mean, an operation, $50,000 operation, you don't want to write a check for $50,000. You want to have an insurance company pay for it.
That's exactly right. So what's become confusing for the customer, the client today, is the vast amount of product in the market. And they're very, very difficult to understand, especially when you get into index products, universal index life, index annuities, and such. But let's get back to what we're the beginning of the topic, which is why are so many people advertising today against variable annuities versus different types of annuities? And do you understand why and what their points are?
No, please, I'd like to know that, and I'm sure our listeners would. Now,
Okay.
This is a variable annuity.
Correct.
Maybe you should
Correct.
explain what a variable annuity is first.
Okay. A variable annuity is a structured product that allows tax-deferred growth, which means you aren't taxed on that money until you pull it out. And usually that's at retirement. Any product in an IRA, an annuity, which is a retirement vehicle, if you take that money out prior to 59 and a half, it's a 10% penalty. But while that money grows, until you start taking the income out of that annuity, it grows tax deferred. So that's compounding growth a lot faster than it would in a normal account. Okay. 2 is variable annuities have various ways to invest your money. So variable annuity is an insurance contract that has a death benefit for your heirs, but it's going to grow in participation, hopefully, with the upside of markets. What types of markets? That can be anything from stocks, bonds, mutual funds, T-bills, but they're all stock market correlated product. So there's a lot of pros and cons to how that product is developed versus some other ones, and I'm going to give you a couple working examples. A variable annuity, the biggest downside to one today, and the reason a lot of people are advising people, if you own one, give us a call because we can help you. And here's really why. While that insurance company is investing your money, your premium dollars, and you sit down with an agent broker and they say, well, we'll put 50% in a bond fund, we'll put 50% into a large cap stock fund. That's all well and great, but what happens is there's management fees, management and expense fees inside of this annuity. And shockingly enough, the average on a variable annuity today is between 2 and 2.5% per year. A lot of them are over 3%, and there's even variable annuities on the market today with over 4% management fees. Now, 4% for a lot of people out there who probably own a variable annuity, have purchased one in the past, probably don't even know what I'm talking about because they haven't looked at the contract and looked at it. But let me give you an apples to apples explanation and comparison. If you're getting charged per se 3% on a management fee inside of your variable annuity, and as you know, the market's been tumultuous over the last 5 years on the minimum, when the market is flat or doesn't go up, you are still being charged that fee. So that's at a 3 or 4% clip, which actually is deducted from the account value. So what happens is a lot of people in the past have bought these annuities 5, 6, 10 years ago, and their account values today are hardly higher than they were when they started. And they don't understand why. They can't figure it out. When they bought it, they were told that this was going to grow at the stock market and downside risk was minimalized. Well, to compare what the real fees are versus a variable annuity fees, I'll give you an idea. Exchange traded funds today, are you familiar with those at all?
No, not at all.
Okay, those are also a new product from Wall Street in the last few years. And what an ETF is a basket of stocks. Okay, in that basket, it could be a health ETF. It could be a transportation ETF. It could be a gas ETF. So what they do is they buy a bunch of stocks and put it in there. Very similar to a mutual fund. The difference is it's traded on the exchange. So you can buy and sell that exactly like you could a stock. Now, comparing fees again, on a variable annuity, again, the average is 2.5, up to a high of 4%. An ETF charges 0.25%, a quarter of a percent, to participate in an ETF, which is growing your money in the stock market. Okay, that's one type of investment versus the high cost of a variable annuity. The next thing, which most people are very familiar with, is a bond fund. If you have a retirement account, you've been growing your money for years. A lot of people have them in all types of accounts. Those fees on there are usually about 0.5%, 0.50, again, versus 3 and 4%. So that's a significant difference. A large cap growth fund might have a 1% asset fee. Okay. And then when you get into what's called small cap growth funds, which is mutual funds, they can charge up to 1.5%. So you're looking at 0.25% to a high of 1.5% on small cap funds versus 3 to 4% per year off of a variable annuity. So hypothetically speaking, would you want to pay 4 and 5, 6, 8 times more for the same type of growth in your money?
Absolutely not.
That's exactly right. And so what we're asking people today to do is, if you own a variable annuity, and that was the most popular product in the late 80s, early 90s, so a plethora of people out there listening to this show today that have these products, you need to look at those, have somebody look at us, give us a call, let us do an analyzation of that annuity, and we can show you different ways to reduce those charges and, in fact, give you more income when you want to retire. And how do we do
Nothing wrong with that.
There's absolutely nothing wrong with that. So what we're trying to discuss here today is the costs of a variable annuity versus different types of investments that are available today. One of the most popular ones today is what's called a fixed index annuity. Okay? Now, what does that do? That allows you to grow your money in markets with using indexes, S&P 500, all types of different indexes. You can participate in European markets, domestic markets. But here's the difference. In a fixed index annuity, which in the last 4 or 5 years is the most sold product in the United States now, it's for two reasons. One is because in a fixed index annuity, your principal that you invested is 100% guaranteed, which means you cannot lose your investment principal. That's the first factor. The second and most important factor is most fixed index annuities today still give you market participation, still give you the upside of the markets with no risk, and those management fees are usually less than 1%.
So how can they do that?
They do it because they've changed the market. They've looked at what's gone on. They understand that the markets have been tumultuous. They understand a lot of people have redeemed these variable annuities because they're not happy with what the end result is. Their money hasn't grown. In years that we've had flatter down S&P 500s like last year, those people lost money because they were still getting the cost coming out of their account values, but no growth. So a variable annuity, if the markets go straight up to the moon like a rocket, could be the best thing you ever had because it does participate in the market, your money grows. When the market goes down, flat, that's when the argument becomes valid that maybe a variable annuity isn't the best spot, especially for people approaching retirement.
And why is that?
Because if you've worked all these years to grow your money, your assets for retirement, and the volatility of the world and the markets going forward, you still have the downside risk, and you're still going to be charged the 2 to 4% on that annuity per year.
I see.
So in a fixed index annuity, you can still participate in the upside. You have no downside risk, and they reduce your fees 60, 70%.
Okay, but if you are in that kind of variable annuity, the first one, can you move it to another one?
You can, absolutely.
Without a fee?
That's correct. Well, you do what's called a 1035 exchange that allows you to move that asset from one asset class to another. It's from an annuity to an annuity. But a lot of people today that I work with, that our company works with, are tired of having 100% of their investable assets in the stock market.
I can understand that.
And these are firemen, these are policemen, these are regular American people. I'm not talking about high net worth people. We deal with those all day as well. These are just regular Mr. and Mrs. Smith who have been working their jobs, have $200,000 to $300,000 in their retirement accounts, but it's the same amount as they had 6-7 years ago, or that they started that annuity with. And a lot of them are they're getting a lot more educated on this subject because there's a lot of advertising going on the internet. As I said at the beginning, if you tag into any high volume website, you'll see a bunch of pop-ups of guys basically advertising the downside negativity of a variable annuity.
Well, I think it's time for me to come in then and tell people. So don't go to those luncheons or breakfasts. Call Rob Coulson. You can go after you speak to him. First, talk to him. Let him make you aware of what you're hearing so that you don't hear one side of it. Let me give you a phone number to call. It's 954-597-6430. That's 954-597-6430. His name is Robert Coulson, and he's the founding member of the US Insurance Auditors, LLC. They're located in Boca Raton, but they will go anywhere. And he is really a very, very smart expert. And I would suggest that you listen to this radio show. In fact, there are a lot of other radio shows you can go that he's done. You can go on YouTube and put in Boomer Times Presents and then look up Rob Coulson, and you'll hear a lot more information. So, Rob, carrying on with this, so someone has an annuity, a variable annuity. Now they can go and switch it. How do they know of all the varieties which one to take?
Well, that's our job, Anita. it is unbelievable the amount of choices there are out there. And again, we are a broker. We're not captive to any one company, which means, in simple layman's terms, we don't have to sell for one company. So there's actually computer programs we run based on age, premium dollars going in, because a lot of these products today to attract investment money have bonuses. Are you familiar with what those are?
No.
Okay. A bonus is a cash bonus on your premium investment. So if you put $100,000 into an account, some of these companies will give you 0% as a bonus. A lot are giving 3 to 10% bonuses.
What do you mean? Money? Extra money?
The credit to your account, and the 3% would be $3,000, 10% is $10,000. Not only that, a lot of the indexed annuities today are not only attracting money on the front with the bonuses, but they're giving what's called a guaranteed ratchet on the income. So how does that work? A lot of the people we work with, most people have a timeline on when they think they would like to retire, okay? Especially a lot of the people we work with. I work with a lot of firemen, a lot of policemen locally, and they know exactly when they're going to retire. They might continue working in another job, but they know when they're going to retire from the fire department. They know when they're retiring from the police department. So we can literally go and look at what they have in that annuity or IRA or whatever type of investment or newfound money they would like to invest and project out. So Robert, I might retire in 7 years. I might work another 3 years. So 7 to 10 years, okay? We can input that into a program. And again, we're a broker that sells all the insurance companies. So my job is to fight for my clients' money. So it doesn't matter to me whether company A, B, C, or Z is offering. We only deal with A-rated insurance companies. And the amount that is the difference in the income that can be derived is night and day. And I'll just give you a quick example.
Excuse me, and I can't understand that, why that happens.
And it's a good question. And it's because every insurance company has their own mortality tables, their own investable money in certain investments. So they know a 60-year-old at company A putting $100,000 in, that same 60-year-old at company B putting $100,000 in. The amounts that they would have for income over if they started at 7 years or 10 years is night and day. Let me give you a real-life example. $300,000 IRA rollover. It's been in a variable annuity for the last 6-7 years. It's almost back to the amount the customer client put in 7 years ago, but it was down about $40,000 this time last year on what he put into it. So he comes to us, says, I already have my pension coming from the fire department. I have a couple rental homes that I'm going to have income. I'm retiring in 7 years. It's my 25th year as my fireman. But I'll probably work another 3 years or do something else. So I want to know, in 7 years, I say, give me my income, which means I'm ready to turn on the income stream, or 10 years. So we go in, we look at all the different insurance companies, and let me tell you how far off they are or what the difference is. That same $300,000 in company A in 7 years is willing to give that fireman $22,000 a year as long as he lives. Guaranteed lifetime income, okay? Again, they're fixed annuities. His principal's protected. He can make money in the markets, but he cannot lose any more money.
And he has $300,000 invested.
Yep. He's going to turn $300,000 from two IRAs, $150,000 apiece, into one IRA through a 1035 exchange. So company A comes back with their projections saying in 7 years, we can give this guy $22,000 for the rest of his life. Go to company B and C. Company C is willing to give this guy $28,000 for the rest of his life.
And why? It's the same $300,000.
The same exact $300,000 investment.
And they've just figured it out differently, haven't they?
They have. And they can either grow the money. They know that their book of business can absorb those costs in their early years. But when you're looking at a $6,000 difference on a guy who's 62 years old, that's a lot of money.
Yes.
That guy potentially, on average longevity, is going to live 25 years. Okay?
It's a lot, $6,000.
It is. You're talking about $150,000 extra in his bank account, right, versus just if he walked into a captive company they would just give them their captive product. And is the captive product terrible? No, but the other one's better. So what our job is, what a real fiduciary's job is to make sure what we're presenting to the client is the best product available. And let me tell you how quickly these things change. Our business takes sometimes a long time to procure, okay? People are busy. A lot of the people we work with have other jobs. So our cycle can be a little bit longer. Why I'm explaining that to you is such. There's so many new vehicles coming into the market on a weekly and monthly basis that if a client came into us 2 months ago and we presented what we presented to them that I'm explaining to you today, and they called me 60 days later, said, Robert, we're ready to move forward with that X company annuity you showed us when we came to see you, I would have to go back and start right at the beginning again, because I wouldn't know if the hundreds of annuity choices that we could make today, 60 days later, is still the best decision as it was 60 days prior. That is how quickly this market is changing.
So if it is good, you need to jump in it quickly, right, and get it, because it could change. Of course, it could change for more or it could change for less. But you, of course, you've been doing this for a long, long time, and so you pretty much, I think, know the companies that are a little bit better than others, I suppose.
It is, and to make it very easy to understand for the listeners, Anita, it's just like a CD at a bank. Okay, if you came into me and as the bank, and I did bank management for many years, and you said I showed you my CD rates 60 days ago, and then you called and said, you know what, Rob, I've been thinking about it, but now I'm ready to do it. I couldn't tell you that CD was the best one then, right?
Right.
Because as you know, markets change daily. Interest rates, what they're willing to lock you in on, whether it's a 2-5 year, whatever it is, you got to think of that concept the same in the annuity. So that's why I urge people, if they have purchased life insurance, an annuity in the last 5 to 10 years, you need to give us a call, because I would be hard pressed to tell you that you still have the best product available for yourself. And a lot of the switches that we can do are not cost prohibitive to you, they're cost effective to you. Because again, the products today have a lot of bells and whistles. They have these bonuses. They have 10% guaranteed roll-ups on your money. So let me explain that to you. That $300,000 in the fixed annuity, the fireman puts it in next month, beginning of the month. That insurance company is going to guarantee the $300,000 grows at 10% per year. So in year one, it's going to be worth $330,000. Year two, it's going to be worth $375,000 because it's growing on 30. So the $300,000 guaranteed on income value projections in 10 years. How much do you think it would be?
Almost like double.
You're exactly almost right. It's about $670,000 or $80,000.
Absolutely amazing.
Yep. So then they trigger that amount. He put in $300,000. His account value and income $680,000. He turns the flip switch on in 10 years instead of 28. It's 7 years. It's now he'll probably get $31,000 for the rest of his life. So the same $300,000 we started with is going to give this fireman $30,000 plus per year, which is 10% growth on his money.
Well, see, that's why people need someone like you. A lot of people get on the internet and they're very inexperienced. They think they know a lot, and they're just taken advantage of. So please, and I love our listeners, and I love our readers. And Rob Coulson has really been working with us for a while, and I think you'll see that he's someone that you can trust, and you can really sit down and let him help you. Again, his number is 954-597-6430, 597-6430, and his website is USInsuranceAuditors.com, USInsuranceAuditors.com. Before we have to end this, talk a little bit about what's going to be happening with insurance and the health insurance supplements, and you've been talking a lot about that.
To be honest with you, Anita, it's anyone's guess going into 2017, because the insurance companies are really scrambling to figure it out as we speak. As a matter of fact, last week, United Healthcare announced in 2017 they're not going to offer any off-exchange plans in Florida because with the new Obamacare that they've been running through the exchanges, you're familiar with Obamacare and these subsidy plans, they cannot make money. They literally said if we continue participating in that market, it'll be destructive to our bottom line and our business. So what's really going to happen, and unfortunately what it looks like is going to happen, is the rates are going to start going through the roof for everybody. And Obamacare rates are definitely going to go up. Rates for everyone are going to go up because in certain markets like the west coast of Florida, there's going to be one or two players left. That's it. When we started selling this business in 1991, we had 8 carriers. And again, we could price them against each other, right? So we could go to Blue Cross Blue Shield, United Healthcare, and Cigna, and Aetna, and all these different carriers and say, I'm trying to insure a husband and wife, 65 years old, with a $5,000 deductible. And you'd have different pricing on all these. Well, the markets are going to get so skewed because of the non-participation of these companies or not even wanting to deal in those counties. Like, I'll give you, for instance, Aetna, who owns Coventry, okay? They're basically primarily a South Florida, somewhere in the east, but they definitely have lower rates than a lot of people because they know which markets they can participate. They know which markets they can support, but they can't do the whole state of Florida. So if you're living in the West Coast, you're living in some of these non-high populated areas, coming into 2017, you're going to have very few choices.
Well, we have an expo coming up, and we have a lot of them coming into the expo selling, which is, Coventry, you just named it,
Yep.
but a lot of others, Blue Cross and all these others.
Mm-hmm.
Well, Rob, for people, though, who are really confused, please do call Rob. I think you'll be very pleased. US Insurance Auditors. He'll tell it how it is. And again, his office number is 954-597-6430. Thanks, Rob.
Thank you very much.